This is World Civilization. My name is Dr. Long. This video is entitled Modern Financial Markets. A financial market is where people buy and sell stocks, bonds, commodities, currencies, futures, and other financial products. Large corporations, banks, and insurance companies are often major players in financial markets. Financial markets are essential to how the modern world economy operates. Financial markets allow corporations, governments, and individuals to raise money in order to expand and to take on special projects. They provide access to much-needed credit. Financial markets are markets that allow investors to attempt to make money, although of course they also involve risk. If you or one of your family members owns stock, has a 401k, has a student loan, a car loan, a mortgage loan, or a business loan, then you, to one degree or the other, are involved in a financial market. Financial markets are a modern phenomenon. They arose in the modern West and then spread to the rest of the world. In pre-modern times, most people were farmers, particularly before the Industrial Revolution in the 1780s. Most people who were farmers were too busy trying to avoid starving to death or disease or war to bother to save much, to invest, or to save for a rainy day. Now merchants, especially those involved in international trade, were the first to accumulate money and to have the foresight to create financial institutions and financial markets. This is just really not possible when you're a farmer struggling to get by and just to feed your family. Financial institutions and financial markets preceded the Industrial Revolution, and during the Industrial Revolution were essential to its success. Now this video will examine three major aspects of financial markets during the long 19th century, 1789 to 1914. And these three major aspects were key to the rise of modern financial markets and an industrial economy. The three major aspects of financial markets that we will look at are banking, the stock and bond markets, and insurance. Banks are financial institutions that accept deposits from customers and loan money at interest for profit. Banking is not an entirely modern phenomenon. The earliest banks were founded by wealthy merchant families in the late Middle Ages and Renaissance. Merchant families seeking to make further profits through money lending. For example, the Medici family in Florence, Italy, and the Fugger family in Augsburg, Germany are good examples of merchant families who branched into banking in the late Middle Ages and the Renaissance. The first big central bank was the Bank of England, founded in 1694 as a way to raise money to finance the building of a stronger English navy. The Bank of England grew stronger over time and came to have a key role in issuing paper money or banknotes that regulated the money supply. It also helped manage government debt, and this was essential for Britain when it financed its major wars against the French, particularly during the Napoleonic Wars. By the 1780s, the City of London came to have several private banks as well, such as the Merchants' Bank's Barings. These banks, as well as the Bank of England, provided credit that helped spur the Industrial Revolution, loans to people building factories and starting new industries. Now, other countries came to have their own central banks. For instance, the Bank of France was established in 1800. The German Reichsbank in 1875, the Bank of Japan in 1882, and the U.S. Federal Reserve in 1913. However, none of these central banks was as successful as the Bank of England, which became the model worldwide. In 1914, the total value of deposits in British banks, both the Bank of England and the many numerous private banks that had developed in England, was a total of 1.2 billion British pounds. Now this indicated that people in Britain had come to trust banks, with much of their money deposited in banks. Banking had become a normal way to save your money and to make financial transactions. People in other Western nations, such as the United States, France, Germany, and Italy, also had large banking sectors by 1914. With many upper-class and middle-class individuals having bank accounts. Many poor individuals at the time still did not have bank accounts. Western banks and large financial institutions loaned money and invested worldwide. This is especially the case with Britain. By 1914, Britain was the world's leading creditor and London was the center of world finance. British banks and investors were especially active in loaning money to Latin American nations during the 19th century to help develop their infrastructure. But other Western nations were active in this regard as well. For instance, French banks provided loans that were essential for Russia to build the Trans-Siberian Railroad. Likewise, German banks such as Deutsche Bank provided loans for railroad construction in the Ottoman Empire. All of this financial activity gave Western banks a global reach by 1914. To use J.R. McNeill and William H. McNeill's terminology, these financial links created a thinker human web, or in Emanuel Wallerstein's terminology, the world system. In the world system, Western banks played a crucial role in making the West part of the core, while those who were taking out Western loans, such as in Latin America, the Ottoman Empire, and to an extent Russia, were part of the periphery. But the activity of Western banks in the 19th century also went hand in hand with Western imperialism, and were part of the West's dominance over much of the rest of the world, and in this case, of course, financial dominance. Now, besides banks, the stock and bond markets were also key to the rise of modern financial markets. Stocks are a share in the ownership of a corporation. Bonds, on the other hand, are investments in which an investor loans money to a government or to a corporation that issues the bonds in exchange for payments over a certain number of years at a fixed rate of interest. The first modern stock market emerged in the city of Amsterdam in the 17th and 18th centuries. At that time, the Dutch were heavily involved in overseas trade in the Americas, Africa, and Asia, especially the Dutch East Indies Company, which issued stock. Shortly after the establishment of the Dutch East Indies Company in 1602, over 1,100 people in the Netherlands, merchants, artisans, and even servants, had purchased stock in the company, making it the biggest corporation of its time. Amsterdam was the busiest port city in Europe, and for all these reasons, it made sense that the first stock market would appear there. Other regulated stock markets were eventually created in other countries, such as the New York Stock Exchange in 1792 and the London Stock Exchange in 1801. Now, one of the biggest drawbacks to investing is risk. You can certainly make a lot of money, but you can also lose your money. You have to accept a certain degree of risk, or it would not be possible to invest or to take out a loan. Prior to the 19th century, laws in the Western world favored creditors. For instance, if a company went bankrupt, the creditors to whom it owed bills could go after the owners of the companies or even investors who purchased stock in it. Now, that obviously made investing in a company risky. Imagine if you bought stock in a company, it went under, and they came after your home. That was allowed under law. And consequently, it discouraged many people from investing. Now, all of this began to change in 1811, when the state of New York adopted the first limited liability law. The concept of limited liability is that if a company goes bankrupt, the most an investor, someone who owns stock in the company, can lose is his or her investment. Creditors cannot go after the personal investments of investors under limited liability law. The concept of limited liability spread to many other American states from New York after 1811, and it also spread to Europe, most famously with Britain passing a law establishing limited liability in 1855. The legal concept of limited liability also encouraged the growth of investment banks in Britain, France, and Germany, as well as joint stock corporations. Joint stock corporations are corporations in which the corporation is owned by stockholders who purchase shares in the company. Many joint stock corporations thus have multiple owners. Joint stock corporations existed as early as the Middle Ages. However, they really grew and became common in the 19th century, with stock in major companies bought and sold on a daily basis for the first time. This all allowed companies to issue more shares of stock in order to raise money to engage in new business ventures, for instance, to build a new factory. Joint stock corporations were thus very important for the growth of industry. Bonds were likewise important for the growth of modern financial markets. Governments and big corporations issued bonds as a way of raising money. England came to have a bond market after the Glorious Revolution of 1688, and by the mid-18th century, Britain had a thriving bond market. Now, this made it easy for the government in Britain to raise money, especially to fight wars in this period, such as the 7 Years' War, fought between 1756 and 1763. The American Revolution, fought between 1776 and 1783, and the Napoleonic Wars, fought between 1799 and 1815. Now, all of these wars featured Britain against its major rival, France. While Britain had a lively bond market that again helped its government finance all these wars, France had a very poor bond market. And this made its government finances less secure. The French government, its finances became so indebted and so restricted that it teetered on the brink of bankruptcy by 1788. And again, this was largely due to its excessive debt, an unequal tax system, and a very inflexible financial system, all made possible, or all that came about by the lack of a good bond market. Now, this financial situation the French found themselves in 1788 played a huge role in the outbreak of the French Revolution the following year. During the 19th century, governments increasingly sold bonds to pay for expensive endeavors such as wars or infrastructure. Investors often saw bonds as a safe investment. Companies issued bonds as well. In the 19th century, bonds issued by railroad companies, especially during booms of railroad construction, were especially popular with investors. However, financial markets, both in banking and stocks and bonds, did feature a great deal of speculation in the 19th century. This led to a cycle of booms and busts, in which markets did well and then crashed. The worst international crash in the 19th century occurred in 1873. The crash, or panic of 1873 as it was called, began on the Austrian stock market, but it quickly spread to other European stock markets and to the United States. The main cause of the panic of 1873, the crash that came with it, was over-speculation in railroad bonds, although rapidly falling silver prices at the time certainly did not help either. The panic of 1873 led to poor economic conditions for several years that even was considered a depression. These was the worst economic conditions in the Western world until the 1929 stock market crash in New York City triggered the Great Depression. Now, the third and final aspect of financial markets during the long 19th century was insurance. In pre-modern times, people did not have insurance to protect them against unpredictable financial disasters, such as a fire or the death of a breadwinner in the family. People who face such disasters and unpredictable events in life had to rely on family or religious organizations or charities for assistance. The principle behind insurance is the principle of risk management. This is the idea that everyone in life faces a certain amount of risk, but it can be managed through an insurance policy, which pays on the event of an unexpected disaster. And this is a way to manage a certain risk in life. Risk to property, risk to life, and so forth. Now, for their part, insurance companies operate on the principle of pooling risk. What this means is if they have enough customers who pay premiums, they can pool their money and spread out the risk, and they can afford to pay out a claim if a few of their customers have one, which statistically is likely. Size, especially large size, is very important for insurance companies to operate on, because the more customers they have, the more money they have, and the more they can afford to pay on a policy in the event of a disaster. Now, the first property and life insurance companies emerged in Britain. After a fire destroyed a great deal of property in London in 1666, Nicholas Barton established the Insurance Office for House Company in 1861 to sell fire insurance. In 1774, the Society of Lloyd's was established to provide for shipping insurance for merchant ships. Now, advancements in mathematics, including in statistics and probability, gave rise to the first major life insurance corporation, as they could calculate the risk of a customer actually dying. This company was the Scottish Ministers' Widows Fund, created in 1744 by two mathematical geniuses, both of whom were ministers and drinking buddies, Robert Wallace and Alexander Webster. While the Scottish Ministers' Widows Fund was originally set up to serve Scottish ministers and their families in the event of an unexpected death, After 1815, it began selling insurance to the entire market in Britain, becoming a major life insurance company. Insurance companies, whether for fire, commercial insurance, merchant shipping, or life insurance, increasingly gave people peace of mind over the course of the 19th century and helped them financially weather unexpected disasters. Insurance companies also, because they had such a large pool to draw from, had money to invest their profits in the stock and bond markets, making them a major player in the financial markets. So let's make a few concluding points. The modern world of finance that we know today, which provides credit and investment opportunities, came about during the long 19th century, 1789 to 1914. This included financial sectors such as banking, stocks and bonds, and insurance. This helped businesses and industries grow during the Industrial Revolution. Since almost all of this occurred in the Western world, it was also part of the West's rise to power and economic dominance over the rest of the world. Modern financial markets have their benefits, but they also have their risk and operate in a boom and bust cycle, with bust often occurring due to overspeculation. The Panic of 1873, which was largely caused by speculation over railroad bonds, is a good example of this. Financial markets grew more sophisticated in the 20th and 21st centuries, but the boom and bust cycle has not disappeared, as for instance with the major downturns in the New York Stock Exchange in 1929 and more recently in 2008. For better or for worse, modern financial markets are essential to the economic world we live in today. I'll stop here. Thanks for watching.